Welcome to the Strategic Pursuit Podcast. I'm your host, Victor Menasce. And today we have a special guest. He has one of the most extraordinary entrepreneurial journeys we've seen on this show. He's someone I look up to very much. He's not just an entrepreneur, he's an investor, he's a developer, a teacher, and a leader. He's the host of the Real Estate Espresso Podcast, one of the industry's leading daily podcasts. It focuses on real estate, business, and investing. Before building that career in commercial real estate, he spent more than 25 years actually in technology sector, including serving as a chief technologies officer of a publicly traded semiconductor company. Today, he's a senior partner at Y Street Capital, developing multifamily, commercial, industrial land projects across North America. He's also the author of Magnetic Capital. Victor Menasce, thank you for coming on the show. It's great to have you.
Oh, great to be here.
Victor, when people see this resume, engineer, technology executive, real estate developer, investor, author, there's one chapter that I want to get into in particular because I feel like it fits perfectly with this show. And it's the business acquisition. I feel like not many people know this about you, but you've completed about 5 acquisitions yourself. But the one that really stands out and I think is very inspirational is the attempt at the IBM microprocessor division. That was roughly worth $250 million. Correct me if I'm wrong, but please, I want you to take us through that opportunity and how it even landed on your desk.
Well, it's great to be here. And that was a fascinating part of my career. Well, let me take a second and give a little bit of the backstory. So, I started my career as an electrical engineer, designing microprocessors, as it turns out. And my first job out of university was with Bell Northern Research. I went immediately into the processor division, got loaned to Motorola, who was developing their own processor. We were going to be the lead customer for that chip. And so I got parachuted into the development team and learned from, frankly, some of the best in the business at that particular point in time. What they were doing was on par with the best of the best. And so learned a ton about that. And then rose through the ranks along the way inside Bell Northern Research, took on progressively senior roles, did a number of different partnerships, both with Hewlett Packard, IBM, Motorola, a number of different companies, again, always in the realm of microprocessor design. And then I left Nortel, B&R Nortel, in 1997. This was before the dot-com bubble had burst. It was still in the run-up of the dot-com frenzy, and joined a startup company called Thunder Semiconductor. And we're doing chips that were the companion chips to these same microprocessors. So all the same customers, customers like Motorola's wireless division, Nokia, Siemens, Ericsson, a lot of folks in the wireless domain, Cisco, Hewlett Packard, like tons of great customers. So we really knew the business well, not from the processor side, but because we were designing the companion chips. Along the way, while I was at Thunder Semiconductor, we did one IPO and we did a few acquisitions from, as it turns out, both IBM and Motorola. In that particular case, it wasn't buying an entire division. It was buying a product or a small portion of the business. That became I won't say a well-worn path, but I really understood the process. And if I go back to the period of around 2003, 2004, at that particular moment in time, IBM was moving a lot of their resources away from these same customers. They went after the triple crown of the gaming business. So they got the Sony PlayStation 4 contract. They were doing the chip that was in the Nintendo Wii, and they got the Xbox 360 processor as well. So they took a lot of their top teams and put them on those gaming platforms, which of course were high volume platforms. And for IBM, that was the right thing to do. But then they had this other division with about 100 customers that was basically being neglected. And we could see it. So I left Tundra at the end of 2003 and then formed a startup company. It was called Somerset Technologies, specifically for the purpose of acquiring IBM's processor division. And so we put together the team, many of the original folks that had been part of the genesis of that division. If you go way back, there was a partnership put together between Apple, IBM, and Motorola around the power architecture, the PowerPC business. And this was put together by Steve Jobs and John Kelly at IBM and Murray Goldman at Motorola, three big names in the tech industry. And we saw this business as essentially being ignored. And, was a $50 million business within IBM. It's a rounding error. It's a distraction. But to us, a $50 million business was a very interesting launch pad. And so we approached IBM. And, I wasn't a big name in microprocessors. I was active in it. Customers knew me, but I wasn't a household name like Steve Jobs or anything like that. So I really went after some of the key players in that business. And every person that I approached with this harebrained idea, I got the same reaction. They would start giggling. Like they would literally start giggling and saying, "Oh, this is wow, really? Oh my God, yes, like I'm in." Before even knowing what the game plan was, they would say, "Yes, I'm in." Like they were just so enrolled in the idea that we could acquire an entire division. It was so audacious that they said, "Oh yes, I'm in." And so that was the start of the whole process. And it started by attracting folks that were passionate about that business, that really understood the business. It was a completely different approach to what you might take in perhaps other businesses, but we got the conversation going.
No, amazing. And I want to talk a little bit about that later on, building that team, because I think that was a vital part of going through this process and getting this deal closed or to the table at least. But for somebody who's listening today, $250 million acquisition, that sounds impossible, right? At what point did you realize that, this might actually happen? We can do this.
Yeah, I mean, when I checked in my pocket, I was a little short. So recognized right from day one that we would need to raise the capital. That was a given. And the way that we figured out how this could be possible is we put together a team of advisors. Now, the advisors were not just knowledgeable folks. I'm talking folks with real direct connections to the decision makers, but they weren't actually in a conflict of interest position. At an earlier point in time, they might have been, but they weren't any longer. So one of the advisors was a lady who used to run that division inside IBM. She reported to John Kelly, who ran the server technology group in IBM, which was at the time a $17 billion segment of the business. And so she knew him personally at very, very deep level. She worked for him for years, and she ran this business. So she knew it inside out. And she knew who all of the players were inside IBM. You need to talk to this guy in the M&A group. This is the legal team. This is where the CFO's office is going to fit into the picture. Like she really knew from an inside perspective. Now, she was no longer at IBM. She was CEO of another company, another semiconductor company. So, and she had just raised a bunch of money from private equity for her own semiconductor business. So she had pathways into the folks that were underwriting technology deals in 2003. And so she was willing to make those introductions as well. Now, Chris is someone who I had known for years. She had run a division in IBM, and I was one of her customers. So I spent a lot of time shuttling back and forth between my office and the fab in Burlington, Vermont. Extraordinary lady. I mean, she was someone who had, I don't know, 50 cows or something like that. And she would literally pull up to the IBM campus in her suit with a skirt and take off her muddy boots, put on her shoes, and walk into the office. Very down to earth, very genuine individual. And we just developed a great relationship over time. So I put together advisors with folks like her that could really advise me at a very deep level. Another advisor was Murray Goldman, who had put together the original partnership between Apple, IBM, and Motorola. He was on the Motorola side. So again, just really folks that knew, not just at a theoretical level, but at a detail level. And so they made the introductions. And so when it came time to actually approach IBM, it happened through one of these back channels. And I'll never forget it. I was literally walking down the street. It was wet snow, heavy wet snow. There were buses going by. And I get this phone call, and I could tell from the area code it was from IBM. And I answered the phone, and the guy on the other end of the line said, "This is Mike Denick. I'm from the M&A group in IBM. I'm told I'm supposed to talk to you." That was his introduction to me. And it was like, oh my goodness, this is my one shot. And I'm here on a wet, slushy, noisy street corner. So I literally ducked into the ATM kiosk at a bank on the corner. All the, the beeps from the ATM machines going on in the background. It was better than being out in traffic. And that was my one shot to pitch him, why we should be talking. And so I did. And his response to me was, well, he said, first of all, you are late to the table where there are 7 other companies in line ahead of you. And you're behind the 8 ball here, but why don't you put together some kind of expression of interest, a letter that describes why we should work with you. And so we did. And that was how we formally got into the process. So we then, on the basis of that letter, got invited down to the microelectronics headquarters, which was in Fishkill, New York. That was where one of the other fabs was. And we met there with all the senior team, many of whom I already knew because I had been working with them for years in other aspects of the business. So it was very familiar in that respect. And, it really just came down to the fact that we had developed a credible team. Now, we hadn't raised the money yet. All we had at that point in time was just a credible team.
A credible team and an idea, and a great idea.
That's right. Yeah.
Yeah. Wow. And I mean, it's fascinating though. You came up with the idea. You knew, well, you had worked with all these other people. You knew how all the moving parts within the semiconductor business, right? So, I mean, building the story and really selling it to this leadership team, these advisors, and getting them on board with you, whether it was a $2 million or a $250 million acquisition, what do you think? Were those principles fundamentally the same? Would they have been the same?
There's different types of acquisitions, and people are selling for different reasons. So, for example, you may have a business that is owned by, let's say, it's a family-owned business owned by some baby boomers, and they're aging out of the business. The kids don't want it. There's no succession plan. They're just selling the business, hoping to extract some value, retain the employees, and hopefully the buyer takes good care of the customers. That's one type of acquisition. And that's, by the way, the most common today. There's lots and lots of those. If you're doing a carve out of an existing business, that's a different type of acquisition. It's very different than buying an entire business outright. This is, strictly speaking, an asset purchase because I'm not buying IBM. It's way too big. I'm buying a few assets out of the business. Now, in this particular case, the microelectronics division was bringing a new semiconductor process online out of the Fishkill fab. The yields were way down, meaning the quality that was being produced was not where it needed to be, and that division was losing money. And the CFO of IBM had basically told John Kelly, don't deliver me another surprise this quarter because I don't want to have to spend 30 minutes on the analyst call explaining to Wall Street why microelectronics lost money again this quarter. So the motivation within IBM to divest of this particular business or any business at that point in time is they needed an asset sale in order to wallpaper over the loss in microelectronics so that the CFO wouldn't spend 30 minutes on the analyst call explaining it again. That was the motivation. There was nothing more, nothing less. And unless you understood that, then you wouldn't really understand how to make the deal come together. We did understand it. And that got us well into the conversation. Now, it didn't turn out the way we would have liked. I mean, there's lots of twists and turns along the way. But one of the things that happened is that the business team that was based out of Raleigh was working with one of the customers, in this case, Hewlett Packard Storage Division. We're building a chip specifically for their big storage arrays. And Hewlett Packard pushed out the forecast for that product by, I don't know, 6 or 9 months, which pulled $9 million of forecast revenue out of the fiscal year. That spooked our banker, who said, oh, we're probably not going to be able to close by the 31st of March, which was the end of the quarter. We're going to need a few more weeks to complete our due diligence. Well, as soon as that moved from the 31st of March, April the 1st, that defeated the purpose of getting the asset sale done in the quarter, because that sale needed to happen by the 31st. And so at that point, myself and a couple of the other folks got pulled into John Kelly's office, and he said, if you can't get this done by the 31st, the price is going to go up, and I need to bring in some competition. I cannot be in exclusive negotiation with just you. And so at that moment, they invited in AMCC, Applied Microcircuits Corporation out of San Diego, who had, by the way, bought another division of IBM about a year earlier. And they were sitting on close to $1 billion of cash on their balance sheet that they had raised in the year 2000 on Wall Street. And as soon as I saw that, it was like, oh, we're cooked. We've lost here, because here's folks with too much money on their balance sheet. They're going to pay way too much, because that's a strategic buyer as opposed to a financial buyer, in this case, the private equity firm that was backing us, and they would pay too much. And they did. They paid almost $100 million more than us. The deal we had negotiated with IBM was for $139 million, in which case IBM would retain 19.9% ownership, which is the maximum that they could retain without it consolidating on their balance sheet. So IBM would continue to be a partner in the business. And then AMCC paid $227. So they paid way, way, way too much. And this was a lengthy process of negotiating agreements. There were a total of 19 agreements. There were 50 lawyers on the IBM side, and we had 3. And yet we knew the details. I knew the details of every single one of those documents intimately. And we were literally negotiating the terms of all of those agreements. So at the end of the day, AMCC scooped it out from underneath us. Now, here's the interesting part. I then went back to one of our advisors, again, Chris King, who had worked for John Kelly. And I called her up and I told her the story. I said, we lost. She said, I know, I already heard. So at that point, she said, well, I know I'm on the board of AMCC. I know the CEO, Dave Rickey. Would you like me to make an introduction? So she did. And so I called the CEO of the company that scooped it from us. And basically, it was a little audacious. I said, what are you doing? You just bought this thing out from underneath us. You don't have any of the expertise to run this business. You don't know anything about it. You need some help. And his response was, well, we were surprised that IBM was talking to a startup. You must be pretty good, because there can't be any other reason they would be talking to a startup. They told us about you. Why don't you and the leadership team come down to San Diego, let's meet. And so we did. And the aftermath of that was they actually bought our company to run the newly acquired division that they just scooped out from underneath us. So different ownership structure. We weren't the principal owners. We were part of the executive team of this newly acquired business. And we were now shareholders in a public company as opposed to a private company, which, by the way, tied our hands a little bit. And this was probably the fastest growing and most profitable division of the company. And so we were a little frustrated because we ended up subsidizing some of the other lesser performing divisions of the business. Still, we grew it. It was throwing off $12.5 million in the first quarter that we owned it. And when I left 3.5, 4 years later, it was almost $25 million a quarter. So we doubled it in size over that 3-year period. So it was a good run. It was a great experience. And working with lots of crazy smart people across multiple different geographies, and at one point had 13 different design centers reporting to me in multiple different countries, and was a great, great learning experience.
You know what? What a story, though. It's amazing to see that it doesn't matter whether, you guys had felt defeated at one point and said, well, you know what? we're cooked. They got the business. It's all over for us, right? We had a good run. We took a shot and, shot in the dark. But I mean, what an amazing, end to it. They ended up looking at the team and saying, yeah, it's not for us. This is who we need, right?
Absolutely.
You guys had that vision all along.
One of the things that really spoke loudly to IBM, and one of the reasons that they were talking to us is, and I set this very clearly from the very first day, an acquisition is a different kind of business than you would experience in organic growth. Because if your business is growing organically, you have time as the business is growing for people to develop in each of their roles. But in the case of an acquisition, that's an instant on business. You need every single person in their chair operating at full throttle day one. They don't have 6 months to figure it out and learn the role. Because if we screwed it up, the customers wouldn't get mad at us, although they might. They would get mad at IBM. And so it wasn't just enough that we took good care of the business. We had to be stewards of the IBM brand. And we understood that, and we were able to articulate that back to IBM, is the recognition that we were going to be stewards of the IBM brand and we needed to protect it. And it was that knowledge, demonstrating that knowledge, that even made them willing to talk to us.
Yeah, no, I heard an analogy that you made at one of your presentations, and it stood out to me. And I think this is a good segue into it, but it's the zipper metaphor. Can you explain that and why it's such like a powerful thing in acquisition?
Sure. If you're looking to do a startup, as many people are, entrepreneurship is a dream for many. Startups are hard, and you're going to end up spending 5 to 7 years to get to break even. 90% will fail, 10% will succeed. So it's just math. My advice would be don't do it. If you're just looking to do a startup, I would recommend maybe just going spend a weekend in Vegas. At least you'll save 7 years of your life, But if you really have an idea that's going to transform an industry and you really believe that you can do something that's impactful, a much better play is to go and acquire an existing business that has revenue and customers and to use the revenue stream from that business to fund the startup. Because at that point, and I can tell you, it's also a whole lot easier to raise money to buy a business than it is for a startup. And the reason for that is because there's revenue, there's customers, there's a whole lot less risk for the investors, especially in the tech industry. Because, think about it. In most businesses, you've got business risk, the business cycle, marketing, people, there's tons of risk. But in the tech industry, on top of that, you have market risk, meaning the market's not fully developed. So you're looking to develop the market at the same time that you're looking to develop the business. And so now you're compounding risk on risk, and your chances of success become vanishingly small. So if you want to go do a startup, don't do it. Go buy a business. And the analogy that I would use is to go buy a business that's in an adjacent space. So imagine that you had just invented the zipper. You had this brand new technology, and the zipper was going to transform and just revolutionize everything from clothing to luggage. Like, this is absolute world-beating technology. Well, you could go down to Sand Hill Road in Menlo Park and go up, this is VC Row, where all the venture capital firms are located, and you could go and try and raise a round or a seed round with the venture capital firms in Silicon Valley. That's what a lot of people would counsel you to do. Or you could go to private equity and go buy a business in an adjacent space. Let's say go buy a button business. Nothing fancy about buttons, but it's got revenue and it's got customers. And when you buy that button business, they have no knowledge that you're going to jam a different technology down that same sales channel. You're buying it for its value as a button business. But the same folks that are customers for buttons are probably also customers for zippers. And so now you can use the revenue stream from the button business to go and develop all of the different product variants. The big, shiny fat zippers for luggage, and the skinny nylon zippers for women's dresses, and everything in between. All those different product line extensions can be funded on the back of the button business. And you can buy the button business for what is essentially a commodity. and they don't know that you're going to be doing something transformational with it.
And it's not hard to tell, right? What'll align or what kind of customers will line up with, whatever startup you're trying to do, right? Merging those two, it's quite easy to tell the customer base. But on the zipper analogy, is culture usually kind of the beginning of that zipper, aligning that inside of a business? What's your thoughts?
That's a great question. Most acquisitions fail for a whole variety of reasons. Sometimes there isn't a cultural fit between the acquiring company and the folks that are being acquired. And if the chemistry of those teams is important, that's something you need to pay a lot of attention to early on. Make sure there is that alignment on multiple different fronts. Otherwise, the chances are high that the acquisition will fail. You will often see other businesses where there's less interaction, where you can in fact roll up multiple different, maybe geographically dispersed businesses that are in the same industry. You see this frequently, for example, in companies like accounting firms. I mean, who needs an accounting firm with like 10,000 accountants? Nobody. Who needs a law firm with 2,000 lawyers? Nobody. And so all of these folks, all these principals, they're outward facing, they're facing customers. They don't really have to talk to each other. So they integrate fairly easily. You see it often in companies like Waste Management that acquire garbage trucks all over North America, all over the world. They just continually aggregating trash collection businesses because the garbage man in Des Moines, Iowa doesn't need to talk to the garbage man in Miami. They don't interact. And so culture doesn't matter if you're aggregating garbage trucks. And so you want to be cognizant of the types of businesses that you're integrating and how synergistic are they? How complementary are they? What's going to be the limiting factor in terms of how this business is going to scale?
That's great. I mean, it makes all the sense to really pay attention to that because, I mean, there's a lot of things that can go wrong during that beginning phase, right? If the cultures aren't aligned. I want to go back to teams because, the IBM carve out that you guys were pursuing, you had an exceptional team and you knew that you needed those A players to be able to go through or see this through, right? So acquisitions, it kind of shows that they're not just an individual process. They're a team sport at the end of the day. Talk to me about what qualities did you consistently look for when bringing, people onto your team?
So whenever you're bringing anyone into your team, you're looking for a combination of skills and attributes. But in this case, even more than that, skills, attributes, and reputation. So that third piece is the one that is more frequently overlooked and, by the way, harder to recruit. So in my case, in the case of the startup we did to acquire the IBM division, I found folks that just had the pedigree. So the original partnership between Apple, IBM, and Motorola was in a small design center called Somerset in Austin, Texas, which is why we called our business Somerset Technologies. And the design center leader was Mark McDermott. And he had people from Apple, IBM, and Motorola all working for him. He was the design center leader. He happened to be on Motorola's payroll, but it didn't matter because the company badge didn't matter inside the walls of the joint venture. And that he's the guy that we pulled in as initially our VP of engineering. The product guy, the business development guy within Somerset was Sam Fuller. Sam Fuller was our VP of marketing. I knew that I did not have the credibility to be the CEO, and this was my idea. So I recruited my boss. I found Brian Wilkie, who ran the computer products division at Motorola. Before that, he ran their automotive division and took Motorola from a modest market share to 52% global market share in powertrain and engine control. And he had Ford and General Motors and Mercedes-Benz and BMW, like really a very dominant position. He had Volkswagen as well. He didn't have many of the Japanese customers. They were typically working with Hitachi for their processors, but he really was a well-known name in the business. And so we put together this core team, had a couple of guys from IBM as well, and just really had a very, very strong team, folks that were recognized within the industry, within the financial community, and most importantly, within IBM, folks that you could immediately, you show them who they were, and they say, oh yeah, I get it. It wasn't, oh, we'll need to look into this and see if they're qualified. It was like, okay, yes, he's the guy. Like it was just no question. And so that's the reaction that you want, is you want to make that frictionless. And so that's what we did. Recognize that we needed folks that were overqualified for that role so that they could be effective in that chair day one.
No, and I mean, it really goes to show that even if the quality of the acquisition, maybe it's not as large, but middle size, if you have a quality team, I mean, in this case, it ended up basically going full circle back to you, right? With that acquisition, or the team that did acquire them, they looked at the team and they needed you guys for it. So that's a great outcome there. I want to talk about the indemnities because I know that a lot of people who are acquiring a business, this is something that's kind of overlooked. Can you talk about the importance of that when you're looking to acquire a business?
Well, there's many different ways to acquire business. You can actually purchase the corporation outright. That's often when a business is for sale, that's often how it's going to be pitched. I'm not a fan of that approach. I would much rather look at an asset purchase, because at the end of the day, you want to purchase the asset. You don't want to purchase the liabilities. Now, you might be willing to purchase some liabilities if they are quantifiable and quantified. But what you're probably not okay with is unknown liabilities or contingent liabilities. So, for example, let's say you're buying, I don't know, an automotive mechanic shop. Okay. Make it a simple business. And they have customers that come in for oil changes and all this other stuff. You could buy the garage in its entirety. No problem. But what about warranty? What is the actual warranty going to look like now, 6 months from now, 12 months from now? How do you quantify the cost associated with fulfilling whatever warranty claims might come in? That's unknown. It's truly unknown. You might be able to quantify it based on historic, maybe. But again, it's unknown. What if they didn't do the brakes properly on one car and there's an accident and there's an injury or worse, and now there's a lawsuit, and if you bought the company, now you're liable for that workmanship that might have happened long before you took possession of the business. So who owns that liability? And that's the purpose of an indemnity, is to basically say, well, if there are liabilities being transferred, then they're not open-ended, they are bounded. It's kind of, think of it almost like an insurance policy. Now, you can write that in a contract, but if they don't have the financial wherewithal to, in fact, protect you, or the insurance coverage or whatever it might be, then the piece of paper is not worth very much. But if it's structured properly, backed up by the proper assets, then an indemnity can be extremely powerful, because the last thing you want is unknown or unbounded liability.
I think that's something that's very much so overlooked, but something that everybody needs to pay attention to, because it can bite you in the ass at the end of the day, right? If you don't pay attention to that. Victor, I appreciate you coming on the show and sharing your wisdom. I know there's so much more that we can get into with all of these different topics when it comes to acquisitions, but we'll save it for another day. But I want to ask you, for somebody who's maybe growing organically, they've done well, and maybe they've hit a plateau and they're thinking about doing an acquisition, maybe a younger Victor, what would you tell them? One piece of advice that you'd give them if they're in that position or thinking about the acquisition?
Money comes in one of three ways if you're running a business. You can go get more customers, you can charge your existing customers a higher price, or you could sell your existing customers more stuff, some other product. Those are really the three ways to grow organically. And so you want to be thinking about, what is my growth strategy? Do I invest in marketing, try and get more customers? That's what a lot of people do. That's the hardest way. It takes 7 times more effort to acquire a customer than to get repeat business from an existing customer. So if you can find existing customers have a need that you're not fulfilling, I'll give a trivial example. Let's say you're in the business of making salt shakers. That's your business. Well, I would suggest that maybe pepper grinders might be a good business to get into, because they'll probably sell pretty well with the salt shakers. Now you could double your revenue or more, because the nice fancy piece of machinery, it's probably more expensive than a salt shaker. So you can find ways to acquire other businesses that are complementary where customers would see value. And oftentimes when you acquire a business, you got to be really clear. It's not just about getting wrapped up in the technology or the features and benefits. You really have to ask yourself some tough questions. If you're acquiring a business, what is that business? What problem are they solving? Is it an acute enough problem that folks are willing to spend money on having that problem solved today, that they really want to shell out money for? The distinction I make is between selling vitamins versus pain medication. Nothing wrong with vitamins, but vitamins are discretionary. If you're solving someone's pain point, then there's an acute reason for people to spend money with you. And then if the answer to those first two questions is yes, then the last question is, are they going to be willing to buy it from you? And if you get an affirmative answer to all three of those, then that could be a candidate for you to acquire that business and add it to your revenue stream and solve the problem for your existing customers and future customers. That's the basic principles that you want to adhere to always when you're in business.
Love it. That's great advice. Victor, thank you for coming on the show and thank you for sharing all of this knowledge again. I know everybody's going to get some good value from this and hopefully have you back on here soon.